with our calculating of ratios and using those ratios to determine a company's health compared to its industry standards. So in this part, we are talking about the ability or a company's ability to sell inventory and then collect the receivables from the selling of that inventory. So we'll specifically talk about three different ratios here. The first one being inventory turnover. The inventory turnover tells us how many times a year a company sells its average level of inventory. So how many times a year is their inventory completely turned over? So to calculate that, we would take the company's cost of goods sold and divide that by the company's average inventory. Now, obviously, average inventory is something we'll have to calculate from the financial statements. So to calculate the average inventory, we will take the company's beginning inventory for that period and add the ending inventory for that period, get the summation of the two, and then divide that by 2 to get the average. The second one is accounts receivable turnover. So accounts receivable turnover tells us how quickly a company collects the cash from their credit customers. So to calculate the account receivable turnover, we will take a company's net credit sales and divide that by their average net accounts receivable. So remember, net sales are your sales after you've taken out the contra sales accounts. So sales returns and allowances and sales discounts. In this case, it's net credit sales only, divided by the average net accounts receivables. So to calculate the average net accounts receivable, we're going to take our beginning net accounts receivable and add our ending net accounts receivable, get the summation of those two numbers, and then divide that number by 2. That will give us our average net accounts receivable. And the third ratio used to measure the ability of a company to sell inventory and collect receivables is their days sales in receivables. So how long does a company's sales stay uncollected? To calculate this number, we'll take our average net accounts receivable and divide that by 1 day's sales. So we talked about how to calculate average net accounts receivable above in the accounts receivable turnover, but we also need to calculate 1 day's sales. To do that, we will take a company's net sales, again that's sales after you have deducted the contra sales accounts, and divide net sales by 365 days. That will give us 1 day's sales. So let's look at an example. So here I've given you some data, balance sheet and income data, and I want you to compute the inventory turnover and the days sales and average receivables. So if you'll push pause on your player and see if you can calculate those two ratios, and then we'll come back together and discuss them. Okay, so hopefully you have calculated the inventory turnover ratio and the days sales and average receivables. So let's take a look and see if you did it correctly. So the first one is the inventory turnover. So as discussed previously, to calculate the inventory turnover, we need the cost of goods sold and the average inventory. So our cost of goods sold was $317,000, and to compute average inventory, we take beginning inventory, which in this case is $71,000, as that was our inventory from the preceding year, and add that to the ending inventory, which was the $77,000 for the current year, and then divide that number by 2. This will give us an inventory turnover of 4.3 times. That means this company turns their inventory over 4.3 times during the year. Again, This you would have to go out and do some research of the industry and find out, is 4.3 times for this company's industry, is this appropriate? So if the industry average inventory turnover is 30 times, then this company is probably not going to be very successful. They may not be a going concern. The other one I asked you to compute was the days sales in average receivables. To compute this one, we need the average net receivables and divide that by 1 day's sales. So the average net receivables is your ending net receivables plus your beginning net receivables divided by 2. And then to calculate 1 day's sales, we take our net credit sales of $464,000 and divide that by 365 days. When you calculate the math here, you will get the days sales and average receivables to be 50 days. Now again, you would want to research this out and find out if this is appropriate for this industry. However, if you're thinking, well, most bills, most accounts receivables are due within 30 days, unless they have different collection terms. So if that is the case with this company, that their collectible terms are within 30 days, and they're not collecting them on average in 50 days, then something's going on in their collections. They're not appropriately collecting their accounts receivables in a timely manner.